Back in January 2018, the asset then known as Navcoin hit its high water mark, peaking at $5.50. Today, it trades around 4 cents, a 99% wipeout. But look closely at that baseline. Despite the collapse, it holds an active market cap over $2.5 million, running continuously for a decade. This leaves us with a difficult question. Is this a dead chain running entirely on fumes, or a heavily suppressed accumulation zone that the broader market simply forgot about? Your read on this depends entirely on what you're hunting. You are either a deep value speculator looking for microcaps with asymmetrical upside, or you are tracking macro trends and want cheap exposure to privacy tech. Navio forces you to weigh two opposing realities: a rare 10-year streak of network survival against an undeniable history of severe capital destruction. Let's look at the actual network to see what remains. At its core, Navio is an independent, privacy-focused Layer 1 blockchain. It operates entirely on its own network, rather than piggybacking on Ethereum or Solana. It launched way back in 2014 under the name Navcoin, and recently underwent a strategic rebrand to update its identity for the current market. The operational structure here is strictly open source. There is no central company behind it, no CEO. The entire network is managed and run by its volunteer community. It targets fast, private payments via a proof-of-stake consensus. Users stake tokens to validator nodes, securing the network and processing shielded transactions. But this pure decentralization creates a vulnerability. There is no centralized corporate treasury or dedicated marketing budget. Without venture capital cash to buy awareness, the network's adoption and daily survival rely completely on organic, grassroots effort from its users. Investing in Navio's utility requires a very specific bet. You are trusting the slow, quiet grind of pure decentralization over the heavily funded, aggressive marketing campaigns driving modern tech startups. The utility of the chain is only half the equation. We need to look at the tokenomics, starting with a circulating supply that currently sits around 77 million NAV. The most dangerous structural flaw is the absence of a hard supply cap. This asset is programmed for infinite expansion. To pay validators, new coins are continuously minted purely as staking rewards. With no token burn mechanism in place, nothing offsets this new supply. The direct financial consequence of this structure is persistent, heavy inflation. As new tokens flood the market, the equity of existing holders is continually diluted. When you apply that dilution to a deep microcap asset with a $2.5 million market cap, maintaining the current price becomes incredibly difficult. Fresh supply is constantly being dumped onto a tiny market. Because of this specific supply structure, Navio is functionally broken as a buy and hold asset. Unless market demand can drastically outpace the aggressive issuance rate, long-term investors are mathematically guaranteed to lose value. That inflation is heavily reflected in the current price action. The sentiment is highly bearish, with the token trading near a 4-cent floor. Looking at the chart, the primary technical hurdle is a massive overhead resistance level at 10 cents. The asset has failed to reclaim this mark for years. Trading a $2.5 million asset means dealing with incredibly thin exchange liquidity. The order books are sparse, and there are very few active buyers on a day-to-day basis. The theoretical upside to that thin liquidity is leverage. A tiny influx of retail buying pressure can trigger sudden, massive percentage spikes in price. But low liquidity creates a chaotic market environment. A single large sell order can trigger a violent downward cascade, wiping out positions in minutes. There is exactly one external macro factor currently working in Navio's favor: growing global regulatory attention and mainstream awareness surrounding digital privacy. As governments tighten oversight, broader market panic regarding financial privacy could act as the sole catalyst driving fresh trading volume into forgotten microcaps. Ultimately, Navio's day-to-day price action is completely detached from the quality of its underlying technology. This makes it a pure momentum play, dictated entirely by macro privacy trends and extreme microcap manipulation. So we return to the paradox. Navio offers a legitimate 10-year history of network survival, but it is deeply handicapped by broken inflationary tokenomics. Let's map your decision. If you seek a long-term safe haven, avoid this asset. Inflation will eat your position. If you are hunting microcap privacy exposure and can navigate low liquidity, add it to your high-risk watch list. The verdict is clear. Navio is an extreme, asymmetrical swing trade. It is simply not a buy and hold investment. If you decide the risk fits your strategy, you can execute the trade on centralized exchanges like Bitget and Bybit, or swap for it on a DEX like SimpleSwap. Allocating capital here means you are trading the security of a battle-tested network for the almost guaranteed danger of unchecked microcap dilution. Know exactly which side of that trade you are on. If this breakdown helped you evaluate the risks, hit the like button, subscribe, and share this with other traders. Let me know in the comments, are you bullish on a privacy comeback, or is the inflation too bearish to touch?